Let's take a look at Chapter 12 problems. We'll start out with computational exercises. On the screen, I've got question 15. And if you recall, the topic is S corporations. So it's another kind of a pass-through entity similar to partnerships. So the question here is Metulus Inc., a calendar year C Corp, owns a single asset with a basis of $325, fair market value of $800,000. Metulus holds a positive E&P balance, earnings and profit. The entity elects S Corp status for 2020 and then sells the asset. Compute the corporate level built-in gain tax that must be paid by Metulus. So the key here is that they elected the S Corp, and there's this pre-contribution gain. So you can see here the basis is 325, market value of 8, so that goes up by 475, so an increase of 475. So upon the sale of the asset, the corporation owes a tax then of $475,000 times the corporate tax rate of 21%, which is $99,750. So let me just kind of show you that here. So in Excel, let's kind of show you what the market value is. Market value is right there. Then the basis is right here. So the difference between the two is the built-in gain. We multiply that by 21%. And we get the amount of the tax. So $99,750. Okay. And then for the shareholder, so we have to go back, look at the question. It says, compute the corporate built-in gain paid by Metulus. Excuse me. So $99,750 is the amount. And then the shareholders of Metulus, of the S Corp, they have to, remember it's a pass-through, so they have to also record a gain. And they record a gain of $375,250. And so what they have to do is, let's go back to Excel. We'll take the 475 of the gain. We'll subtract the $99,750, the tax paid. And so the owners of Metulus will pay a gain of $375,250. So what this does is it imposes a double tax. So the corporation, Metulus, as a C Corp, has to pay a gain. They have to pay tax in $99,750, and then the owners will have to pay a capital gain tax on $375,250, of course, on their personal returns, and we don't know what their amount is, but it's either 0, 15, or 20%. So at the most, they pay 20% of that amount. Okay, question 16 I'm skipping, so we'll go down to question 17. It says here that Dion, an S shareholder, owns 20% of Meadowbrook stock for 292 days and 25% for the remaining 73 days. Upon using the per day allocation, compute Dion's share of the following S Corp items. So ordinary income, tax-exempt interest, and charitable contributions are the big three. And it's pretty simple. It's just really just doing a ratio and going from there. So let's go through and just go ahead and we can just type in what those are here pretty simply. So the three items are ordinary income, and that was $60,000. And then remember, we kind of have two different allocation percentages. So for 292 out of 365 days, so that amount, they owned 20%, so let's do 0.2. And then the other amount was 73 divided by 365, so for 1/5. So basically it works out to be, it simplifies it for me here, it's 80%, 20. And we multiply that times 0.25. So the 60,000 is split between the two. Okay, so we just go ahead and do the math and just multiply everything out. So just multiply everything across, and that will get us to our allocation. I can just drag this down, and obviously the sum of the two would be my answer. So 9,600 and 3,000, and the total then is 12,600 between the two. Okay, so that was ordinary income. The other one was tax-exempt interest, and I can kind of do the same thing. I'll just use this overlay this amount. So that was $1,000, and it'll work the same way. I get $116.50 for a total of $210, and the last one was charitable contributions, and that was $3,400. So we get a total of $714. So pretty simple, just doing allocation, but that'll be a homework problem that you'll have for your work this week. The next one is question 18. Noelle, the owner of all the shares of Clock Co. and S Corp, transfers her stock to Grayson on April 1. Clock Co. reports a $70,000 net operating loss for the year, but only $10,000 of the loss occurs during January through March. Without a short year election, how much of the loss is allocated to Noelle and how much is allocated to Grayson? If the corporation makes a short year election, how much of the loss is allocated to Grayson? The tax year is not a leap year. So we basically just do the math. Is really, again, it's kind of an allocation. So January, February, and March are 91 days. It's literally looking at the calendar and also assuming it's not a leap year because that matters. So January, February, and March is 91 days. So let's go over back to Excel. And let me get rid of this. And so we can take 91 days. That's 91 out of 365. And we just do the math on that. And we can just take that, divide by that, and get a percent. And I multiply that by 70,000. Okay, so if I just do the math of 25% times the 70, I get 17,452. So that's without the short year election. That's just allocating. With the short year election, then basically Grayson gets 60,000 because we knew that 10,000 belongs from January, February, and March. So basically Grayson gets 60 and Noelle gets 10 because we know exactly what it is. So it just depends if we do short year or we do not. Question 19 is Grenier Inc. as a calendar year S Corp holds no AEP, accumulated earnings and profit. During the year, Chad, an individual Grenier shareholder, receives a cash distribution of $30,000 from the entity. Chad's basis in his stock is $25. Compute Chad's ordinary income and capital gain from the distribution. What is his stock basis after accounting for the payment? Okay, so the key here, recall, is this exceeds his basis. So $30,000 distribution, $25,000 basis. So this kind of goes back to stuff we've learned in previous chapters. Pretty simple. $25,000 is tax-free because that's return on basis, no tax. But the extra $5,000 would then be a capital gain. Okay, and of course his basis would be zero. So zero basis, $25,000 tax-free, and then $5,000 is capital gain. Okay, next is question 20, and you can see here it says that Holbrook Calendar Year S Corp distributes $15,000 cash to its only shareholder Cody on December 31. Cody's basis in stock is $20,000. Holbrook's AAA balance is 8, and Holbrook's holds 2,500 AEP. And then before the distribution, complete the chart below using spreadsheet software such as Excel. And it's really that you don't necessarily have to use Excel, but it's just a matter of building, kind of having the spreadsheet right here and kind of going from there and plugging in the numbers. So the key here is when you're just doing a distribution from an S Corp with AEP, first comes from AAA. Okay, so AAA is the first thing that we hit. Distributions from AAA are tax-free. The remaining distribution is taxed as dividend to the extent of AEP after AEP is fully distributed and residual amounts applied against other accumulated adjustments account, the OAA. And then the shareholder remains, and then against the remaining basis. Remember that reduction in basis is tax-free recovery of capital. Return on basis is tax-free. So it's kind of a way to look at it. And so the numbers, the way they'll work out is we look at the AAA first. That's the full 8,000. So the 8,000 would go right here. And the effect on basis would be 8,000. And then we go 0. So we go 8,000, 8,000, 0. From AEP then is the 2,500 right here. So 2,500 here. That does not affect basis, so that's still a 0. Then this last one is what's remaining. So what's left over to get down to the total distribution of 15,000 is 4,500. So if I go down, I go 8,000, 2,500. What's left over to get to 15 is 4,500. That 4,500 does reduce the basis, okay? And so over here then the balance after distribution is 7,500. Okay, 7,500. So I'm just going to type in the numbers here. I'm not going to label everything, but I'm just going to type in the numbers right here. So just use CML. So it's 8,000, 2,500, and 4,500. And the second column is 8,000, 0, 4,500. Last column is 0, 0, 7,500. So this is the remaining basis, the 7,500. So if you recall, the original basis is 20,000. So 20,000 minus the 8,000, which reduces basis, and the 4,500, which reduces basis, that equals the $7,500 amount right here. Just wanted you guys to see that. Okay, so let's go back to the question. So I just filled in these three columns represent these three columns right here. Okay, the next question is question 21. Vogel Inc. is an S Corp. For 5 years, distributes a tract of land held as an investment to Jamari, its majority shareholder. The land was purchased for $45,000 10 years ago. It's currently worth $120,000. As a result of the distribution, what is Vogel's recognized capital gain? How much is reported as distribution to shareholders? And then what's the effect on the AAA? And we'll come back to part C. So for part A, it's really pretty straightforward. They recognize a capital gain, and so let's kind of take a look at the numbers here. 120 minus 45 is 75. So for part A, $75,000 capital gain increases the AAA by $75,000. Okay, so the gain appears on Vogel's Schedule K, and a proportionate share of that passes through to the shareholders' return. So whoever the shareholders are, each get a portion of that. For part B, the net effect of the distribution on AAA. So the property distribution reduces AAA first by the 120, the fair market value, but then it also increases it back by $45,000. So the net effect is a $45,000 increase. Decrease, $45,000 decrease, which is $75,000, the gain, minus the fair market value of 120. So $45,000 decrease is the answer to B. For part C, assume instead that the land had been purchased for 120 and is currently worth 45, so it's upside down. How much would Vogel recognize as a loss? What would be the net effect on Vogel's AAA? What would be Jamari's basis in the land? So in that example, Jamari, the majority owner, would take a $45,000 basis in the land, the fair market value. The $75,000 realized loss is not recognized at the corporate level. The loss reduces Vogel's AAA only when the S Corp sells the asset. Does it recognize the loss? Okay, so it has to sell the asset to recognize the loss. Question 22. Jonas is a 60% owner of ARD, an S Corp. At the beginning of the year, his stock basis is 0. Jonas' basis in a $20,000 loan made to ARD is evidenced by ARD's note and has been reduced to 0 by prior losses. During the year, Jonas' net share of ARD's taxable income is $10,000. At the end of the year, ARD makes a $15,000 cash distribution to Jonas. After these transactions, what is Jonas' basis in the stock? What's the basis in the debt? And what is Jonas' recognized capital gain? Excuse me. So keep in mind that basis can never go below 0. But the shareholder's debt basis is reduced when the loss is greater than the stock basis. Okay. So the stock basis goes up by 10,000 for the taxable income. Okay, for the 10,000 of income. So that's an increase to basis. But the $15,000 distribution reduces the basis down to 0. So it goes up by 10. Then we do a distribution to get it down to 0. The debt basis remains at 0, and the shareholder recognizes a $5,000 capital gain. So it goes up by 10, goes back down to 0, and the extra 5,000 is capital gain because we've already reduced this note down to 0. Okay, so that's the issue with that one. Okay, the next one is one of the problems, question 24, and it says here the profit and loss statement of Kitch and S Corp shows $100,000 book income. Kitch is owned equally by 4 shareholders. From supplemental data, you obtain the following information about items that are included in book income. So it says here, compute their non-separately stated income or loss for the year. So basically, what was their income that equally applies to all 4 of the partners. So it's basically just kind of doing a little bit of a mini income statement. So kind of just take a look at the numbers right here, and we'll build a little mini income statement. So we take our book income first, which is right here at $100,000, and we make adjustments to it. So we'll start out with book income of $100,000. So I'm just going to use some abbreviations here. Let's call it BI, book income, for $100,000. Okay, and then I add to that, go back to the question here, the long-term capital loss. So I add the loss back, so $6,000. So long-term loss. Okay, so I add that back, and I have 106. When I do some subtraction, so I'm going to subtract a few things. I'm going to subtract dividends received. Okay, so right here, the 9,000 dividends received. And I'm going to enter those as negatives. I'll be subtracting. Same thing for tax-exempt interest income. Right here, the 3,000. So let's call it tax-exempt interest income. So I'm abbreviating severely here. Minus 3,000. I've got a Section 1231 gain of 7,000. And then I've got passive activity income. And passive activity income is $5,000 right here. So passive activity income for $5,000. Okay, so I just basically add down. So I take the 106, add down, and I get 82,000. So that's the non-separately stated income. So I took their book income, added back the loss, subtracted out the separately stated items essentially to get down to $82,000. Okay, so that would then be shared equally by all 4 partners. I don't need to state that one separately, because remember, the goal of stating something separately is these items right here, the long-term loss and all these other items right here, it's a flow through, so we have to worry about the individual partner's tax situation as to what tax rate will be applied to those. Okay, so that was A. B, what would be the share of this year's non-separately stated income or loss items for James Billings, one of the shareholders? So that's pretty simple. It's just taking the 82,000 and dividing it by 4. They said there's 4 equal partners. So just take that number, divide by 4, and I've got my answer, 20,500. That's pretty straightforward. And then for part C, the question is, what is James Billings' share of tax-exempt interest income, if any, is the income taxable to him this year? So again, we just go to the tax-exempt interest income right here. He's an equal partner, right? So we just divide by 4, and you get 750. And because it's not taxable, he does not have to pay tax on that. That's the whole point. So he does not pay tax on that. So that was question 24. And you'll definitely have questions just like that one as you go about and do your homework for the week. So from there, we'll go and move on to question 28. Right here. January 1, it says here that Kinney Inc. and S Corp reports $4,000 of accumulated E&P and balance of $10,000 in AAA. Kinney has 2 shareholders, Aaron and Frank, each one of whom owns 500 shares of Kinney stock. Kinney's non-separately stated income is $5,000. Kinney distributes $6,000 to each shareholder on July 1. He distributes another $3,000 on December 21. How much are the shareholders taxed on the distributions? Ignore the QBI deduction. So it's very similar to what we've done previously. It's doing kind of an allocation of the 2 numbers. So AAA is the 10,000 plus the 5,000. Okay, so 10,000 plus 5,000 is my AAA. before we take into account the distribution. So the sum of the distributions is $18,000. Okay, so we have to kind of look at that too. So just 6,000 equally in July 1, and then 3,000 equally in December 21. So double that's 12, double this is 6, that's 18,000. So the key here is the sum of the distributions, 18,000, exceeds AAA, which is 15,000, the 10 plus the 5, by $3,000. So a portion of the 15,000 AAA balance is allocated to each of the distributions based upon the size of their distributions. Okay, so let's go back into Excel and we'll compute that. So I've got the first one on July 21, and that's basically 12,000 divided by 18,000. Then I multiply that by 15,000. Okay, so I take the 12, divide by the 18, and then I multiply that. Let me get my brackets in there just the right way, by the 15. Okay, and I get 10,000. Then do the same thing for the next time period, which was December 21. So this time it's December. That was July 1. I said July 21. It was July 1. The next one is December 21. Okay, so for this one I just take 6,000, which is the distribution in December, divided by the 8,000, multiplied by the 15. So I get my allocation as 10 and 5. So remember then we distributed 18,000. 15,000 is allocated to the AAA. That leaves $3,000 left over. So they each report a $1,000 dividend income as of July 1. So going back to the question, that's when $12,000 was distributed. So 6,000 each. So coming back to here, 12,000 was distributed back then. The difference is 2,000. That's dividend income. So basically I just take that 12 and subtract the 10. And so it's $1,000 for each of the partners as dividend income. I do the same thing here. That was a $6,000 total. And I do kind of the same thing. That should be a $1,000 difference. And I split that evenly to 500 for each one of them. Okay, so that's how that one works. I have to do this little allocation first of AAA and then go from there. The next question is question 29. It says Macklin Inc. is a calendar year S Corp. AAA is 0. Macklin holds 90,000 of AEP. Tobias, the sole shareholder, has an adjusted basis of 80 in the stock. Determine the tax aspects of 90,000 salary paid to Tobias. Ignore QBI. So for part A, Tobias recognizes 90,000 of ordinary income. Okay, so that's ordinary income to him, just like it was salary. The corporation, of course, can then deduct that and pass that through. So basically, they can reduce AEP by $90,000 for that reason. His stock basis is reduced to 0, though, and he holds a $10,000 loss carryover. Okay, so that's what would happen with that one. For part B, same, except that now he takes a cash distribution. So if he does that, that's 90,000 dividend income with no deduction pass-through, and he's an $80,000 stock basis. AEP is reduced to 0. So it just depends on what you call that. If it's a salary or if it's a distribution, it affects things differently. Question 30 says here, Tiger Inc., a calendar year S Corp, is owned equally by 4 shareholders, Ann, Becky, Chris, and David. Tiger owns investment land that's purchased for $160 4 years ago. On September 14th, when the land was worth $240, this distributed to David. Among David's basis is his in his S Corp stock is $270 on the distribution date, discussing the federal income tax ramifications of this distribution. So he's going to have a capital gain. Take a look at the $240 minus the $160, and that would be an $80,000 capital gain to be reported at the corporate level. So each shareholder then, because Tiger has 4 owners that are equally shareholders, 80,000 is divided by 4 for 20,000, and each one receives a $20,000 capital gain pass-through. Okay, that's the first part of it. Now for David, his stock basis drops to 50. Okay, so he takes the 270. He then adds 20,000 for his share of the capital gain, but then he also has to subtract the 240 value of the land. So for David, it's 270 plus 20 minus 240. So that results in 50,000 left over. Okay, then one more question. Question 31. Jack and Mary, a married couple, report taxable income of $280. Includes $200,000 from Jack's solely owned S Corp. The S Corp paid wages of $100,000 to employees, not including his salary. Calculate the couple's QBI deduction, if any. No acquisition of depreciable property was made during the year. For this one, it's $40,000. And there's kind of a rule for this, and this is way back to Chapter 2, is when we talked about this. This is basically the first week of class. The QBI wage limitation for a married couple is $321,400. The couple's taxable income of $280 is less than $321,400. So we calculate the lesser of two things. It's the lesser of 20% of QBI of $200,000, okay, right here. So 20% of that is $40,000, so it's the lesser of that, or it's the greater of 50% of W-2 wages of $100,000 or $50,000, which is basically 50% of W-2 wages of $100,000 is $50,000, and then 25% of $100,000 plus 0, and 25% of $100,000 is $25,000. So we're looking for the lesser of $40,000 or $50,000, and obviously $40,000 is less than $50,000, so therefore we're in good shape. Okay, that's question 31. And that really wraps up chapter 12 homework then. It should be, for the most part, fairly similar to some of the things we did for partnerships. There's just a few quirky things that are unique for S Corps that we have to kind of think through. So hopefully, if you kind of think, it's very similar to a partnership. It's just S Corp has some quirky things that are unique. You should be in pretty good shape.